Joining us right now is Joe Davis, Vanguard's global chief economist, global head of investment strategy. Vanguard recently released its economic outlook for 2026. Good morning to you. Let's talk about the outlook in just 1 second. But CPI, what do you expect? What should we be looking for today?
Well, I think it's going to be mixed. I mean, I think we will see a trend that's in some components is coming down, but you'll see some pressures, the areas tied to either tariffs and then some of the food prices that we're all contending with. So again, I think it'll be a mixed picture. It'll leave the Fed in a modest, cutting or easing bias, but nevertheless, it's one of the challenges the economy faces.
And so, Joe, let's sort of leveraging sort of where we are right now, we're obviously almost at the end of the year. Yeah. If we come back and discuss next Christmas what the year was, what do you think it'll look like?
Well, again, there are some headwinds that we're still working through. I think the ultimate factor will be how much AI-related investment we will see, particularly in the back half of the year. We start to see, upside risk to the U.S. economy. That's not to say there's not challenges in the near term. I mean, the labor market has effectively stalled and is in a holding pattern. There's several reasons for that. But the swing factor is clearly going to be investment. And with that, what does it do to job growth? That's the theme of our outlook. And so that's where the risks across the world are mixed, dependent upon the velocity of the investment.
So what do you think is going on in the jobs market right now?
Well, you're just mentioning supply and demand. There are both forces at work. There's been acceleration in retirements, those over the age 65 in particular. Obviously, immigration has slowed, and so that has pushed down the so-called, break-even rate. But we're still working through, some of the tariff uncertainty, which was delayed. It was not eliminated. It's not AI automation. Some of the job growth is actually strongest in those occupations that, at least right now, have high AI exposure. And our own 401k records that track job growth pretty closely show that, younger workers, it's at historical levels. I'm not saying it's booming for younger workers, but it's not some of the narratives that we hear. So it's both coin and businesses holding pattern, as well as just lower supply of new entrants coming in the market. So again, investment spending and business confidence will really determine the risk to the economy in 2026.
Okay, but then speak to the other side of the story, which is the inflationary picture.
Yep.
How much inflation do you think we're going to see? How much of that is a function of tariffs? How much do you think it's a function of something else?
I think there is a lot to be said of tariffs, as well as what we believe we've said pretty strongly for 2 years. The Fed is not as restrictive as they think. And so, I'd say they're fairly neutral. I think there's a greater appreciation for that more recently. So I think if you put those two together, you can get inflation above 2%. Where we go from here, I think will be less a productivity story. It will be much more, let's settle down in some of the tariff related uncertainty, some of those volatilities. And then I think the focus for 2026, believe it or not, will be more on the growth than on the inflation side.
And then finally, if we could make you a candidate for the next head of the Fed, what would you be doing?
I would be looking at how high productivity could go over the next 2 or 3 years. I mean, there are some strong arguments, and we've made it, that there's the possibility of a late 1990s, somewhat of a surge in growth, which is non-inflationary. That has important implications for what the Federal Reserve should do. So that's always, not an easy exercise, but that's where I would be spending a lot of time. Because you can have policy that can accommodate higher growth, thinking that you don't have to be as restrictive. That's going to be important for the financial markets.
You think we could have lower rates without? Are you suggesting we need lower rates or not? Then
I think you can have. Well, our research is clear. You do not have higher rates with higher growth. Not if it's given from higher productivity and innovation rates. That's what we saw in the late 90s. You can have a 4% 10-year Treasury yield. And have inflation holding pattern, yet you can have a 2.5–3% GDP. It's because it's not just demand. You're getting higher capacity. That's the key area the Fed needs to look at for the next 2 or 3 years.